Valerie, we've heard over and over again the concept of the neutral rate, where the Fed needs to hike to in order to balance supply and demand and then rein in way down on inflation. But you've come across a new concept, which I know you're very excited about. It might complicate the Fed's inflation fight. Take us through the detail.
Thanks, Anna. Yes, you're right. Okay, so we have this concept of R star. As you mentioned, it's the neutral rate where supply and demand in the economy are equated and there is no inflation. I want to talk about a new concept. It's called R double star, which sounds like something out of a Star Trek movie, but I digress. R double star is the neutral rate for financial stability. Now, normally, R double star, R star, will be roughly the same thing, but this new paper out that was discussed at the NY Fed meeting last Friday claims that after a period of low interest rates, the gap between R double star and R star starts to widen. Now, that means that R double star is now below R star, meaning as the Fed begins to hike rates because of the excess leverage in the economy, we hit the level of financial instability before we hit the level of supply equaling demand and no inflation.
Okay, so this suggests then the Fed is going to find it difficult to bring down inflation because it's going to trigger financial stability before we even get there. So take us into your chart. I see a couple of arrows there, tantalizing arrows as they are, pointing to two periods of Fed hiking cycles. Why is it different this time?
Yes, I've highlighted the last two. So the first one here obviously ended with the credit crisis. But the cracks that we started to see there emerged in the credit market. That was financial instability. The second one here in 2015 to 2019, it was a slow and steady hiking cycle, but we had financial instability cracks start to come in the repo market, in the treasury market. Now, in both of these cases, we didn't have a period of low for long inflation rate or lower for longer rates previously, meaning that R star and R double star were roughly the same. So inflation came down when we hit this period of financial instability. Now, the dynamic of today is that because this gap is widening, because of this excess leverage, the Fed could have to pivot to save financial stability, maybe the treasury market breaking down, for example, way before it dents inflation at all, which is quite a terrifying concept because we're all talking and getting very excited about this Fed pivot.
Yes.
But what if the Fed is forced to pivot and inflation doesn't change? We still have core PCE near 5%. We have jobless claims, under 200K. The labor market is still strong. Meanwhile, the financial market starts to show huge cracks. What does the Fed do in that kind of scenario? It kept me up all night, Anna, and honestly, I'm a bit worried that we have this payroll print on Friday. We just are maybe one strong payroll print away from seeing this play out in real time.
It's really interesting. It's a very interesting concept. I wonder if we're focusing on a Fed pivot in too much of a binary fashion, though, because what we've seen from the Bank of England has been interesting, and perhaps this has read across the fact that the Bank of England is still hiking interest rates. That's what they tell us. But at the same time, they're doing very targeted operations to ensure functioning of financial markets, which could be described as QE. So is this going to be the future?
Yeah, the Bank of England threw this wide open. It was kind of a narrative I was trying to put together in my head all weekend, right? Of hitting these roadblocks before the battle has almost even begun. And the situation that the BOE found themselves in, I'm sure the Fed is looking at too very closely and getting quite worried about.